This is Chip Maxwell, and you're listening to the Retire Smart Podcast with David Brooks. In this episode, we kick things off with a look inside the Tax Mastermind seminar, where advisors from across the country gather to sharpen their tax strategies and better serve their clients. From there, we dive into the headlines on the risks of chasing invest like the 1% real estate promises, looming premium hikes under the Affordable Care Act, and how politics and policy ripple through your financial life. A couple times, we'll get to the news, of course, but a couple times a year, you put on a seminar called Tax Mastermind, and this is one of those times. In fact, one of the participants is going to join us in the second segment of the show. Just give us a quick rundown on the Tax Mastermind seminar.
Yeah, so we've been doing these for, I guess, our sixth year doing these a couple of times a year typically, where we host, one or two dozen or so advisors from all over the country. These are typically independent fiduciary advisors, very similar to us, that are seeking better tax education, tax knowledge that they can go back and implement with their clients to give their clients more of their hard-earned retirement savings. And so we've been blessed to do it. We get great feedback every time we do it. And, we believe, like we do with our advisors here, iron sharpens iron. So bring together a collaborative, and the outcomes are phenomenal. So we're really excited to host them. And we get to treat them to the best piece of red meat they typically have. So we always have to ask them the questionnaire when people sign up to come. Are you a vegetarian or a vegan? It's okay. We just need to know.
So that'd be about 20 people, right?
Yeah.
Coming in for, good. All right. Well, we'll hear from one of the participants, as I said, in the second segment. All right. Into the news we go, David. Wow. You sent me this story from CNBC. The headline is, so the phrase is invest like the 1%. That was the slogan this company was using. And so the headline is, when invest like the 1% fails, how Yield Street's real estate bets left customers with massive losses. Now, I know you love real estate as an investment, but there are pages and pages, example after example, of people getting hit with $6 and $7 million losses.
Well, we've talked about the corporate real estate market has been in pain. We talked about it right on this show. I don't know, a month ago, I sent you 2 office buildings that sold for a total of $12 million in downtown Denver in the tech center, right? South of Denver. Real estate selling for, less than a lease might have been for 10 years of one floor of one of those office buildings. And that's all over the country. We had the San Francisco examples. We've been covering it for the last 2 years. Well, real estate is a phenomenal investment. However, it's an illiquid investment. And so this tagline of invest like the 1%, what this company was doing is trying to use it as a marketing ploy to entice people. And it's true. The uber wealthy, those that have at least $10 million or more in liquid net worth, about 53% of their assets, Chip, are in non-publicly traded investments, non-liquid investments, center city real estate, multifamily real estate, private equity, private credit. They own things that they don't price every day, right? And they're not in a panic when they need to access their money. The problem is this company, Yield Street, tried to go after the mass affluent and tease them like, hey, we'll get you into these investments that the wealthy get. Well, the wealthy have some luxury a lot of other folks don't, Chip. They don't need liquidity. They don't need access to their funds. And real estate and other investments like this are very long-term plays. And we do. We offer very unique alternative liquid and illiquid investments to our properly accredited investors, what's called accredited or a qualified investor. That means you have at least $1 million to be accredited in liquid assets or over $5 million for a qualified. That's who these type of investments are meant to be for. And you still have to make sure they have enough liquidity for their lives, their income needs, et cetera. This company kind of, they didn't do their due diligence on each client. They just took the cash and they bought some real estate that was some of the examples we just talked about that got crushed in value, 60, 70, 80%. I was reading the story. There was one example where a gentleman who had only about $800,000 in savings, so he should not have been in the investment to begin with, lost over $400,000. So, this is kind of stuff that people should go to jail for, frankly. And sadly, though, the company will end up probably bankrupt, so you can sue, but the only one going to get paid probably out of that as the trustee is the attorneys in some kind of class action lawsuit.
It's enticing because, as the story says, their pitch line is, we're going to democratize access to real estate investing. We're going to let the little guy play in the same arena with the big guys on this, but you can get crushed if you do that.
We have the alternative investments now available. Like, we can get people access to the NFL, right? NFL started allowing private equity just a year and a half ago. And so that's in some of the investments we have for clients. But you're not getting, and it's a slither of a share. Let's be mindful, but it's fun to say you're an owner, maybe of the Buffalo Bills, what have you. But you need to understand is what comes with that, though, is you're not getting out of that investment. It's not like, hey, tomorrow I'd like to cash that out. No, there are exit points, typically years sometimes with some of these illiquid investments. You have to commit your capital 10, 12, 15 years. But it is true. That is how the wealthy truly get wealthier, because the way wealth is created in this country, and again, this is what we need to teach young people, is assets appreciate over time. That's due to inflation. Inflation rises assets, gold, silver, stocks, bonds, real estate, houses, but all you have to buy them, but you have to be willing to hold them for a long period of time. And that's why they're typically only for people that have more than enough liquid cash available.
Be careful, do-it-yourselfers, caveat emptor, buyer beware. All right, David, Fortune magazine headline, perfect storm to hit Obamacare. Millions could see premiums surge 75% in 2026. Now, wait a minute. Obamacare is already incredibly expensive. What is going to drive this new surge?
Oh, you want to call it by its real name? The Affordable Care Act?
Yeah, right.
Anything but. So premiums are up 670%. So over almost 7 times since that bill was passed in 2009, I believe. And here we are 15 years later, and you're paying 670% more. If that was nominal inflation, you'd only be paying about 25% more, right? And here they are. They want to push it another 75%. And insurers, over 312 insurers have filed and asked for over 25% increases, 180 of them for over 75% increases. I don't remember the exact numbers in there, but why is this? Well, you have to understand is this was padded with all these side subsidies to get the numbers passed, right? And you don't walk, there's a bridge that you will not walk on that crosses over from here to Iowa. So we always talk about it, right? So we happen to have a bridge, for those that don't know, that's a unique tourist feature here, but Chip Maxwell has never set foot on this bridge.
A monument to earmarks and pork and all the
because that was the Cornhusker kickback, right?
Thing.
And that's what happened.
Well,
all this is coming due. You have to pay those bills. They were kicked down the road, and all those bills are coming due. And so the subsidies are drying up that would fund the bill. So again, to solve this, it's very simple, but logic and reason are not used in the political world. Stop trying to cover everyday health care with health insurance. Insurance means to indemnify you of an unexpected loss. Daily health care is not unexpected. So we should go back to indemnity policies where maybe the insurance only kicks in above $20,000 or $25,000 threshold. And then we could create healthcare memberships, right? That's how my wife and I, we pay a doctor a couple dollars a month and we have access anytime we want to them. We need to get back to doing that where you get your basic healthcare for a membership. And employers would love this, frankly, because it'd be much cheaper.
More of a market dynamic.
Yeah, I could buy a membership for my employees, and then the insurance premiums would drastically shop because it's really only for the crucial stuff. But anyway, that's, logic, just goes out the window in politics.
The Cornhusker kickback was actually a sweetheart Medicaid deal for Nebraska, but that Kerry Bridge is the same species of Washington operation. But I won't go down that road, at least not today. David, here's a headline from the New York Post. The Bank of America. This is a chaser, actually. We talked about this last week, about this debanking phenomenon. Bank of America finally axes rule that sparked debanking of conservative religious groups. This was not tinfoil conspiracy stuff. They
actually had a rule. They admitted, hey, we had a policy, and not religious groups, because they did it for Muslim groups. They did it for other groups, no problem. But if you were a conservative Christian or Catholic group, you got put onto the back of the file, and it would take 9 months, if they approved you on average, to get a bank account open. I mean, it's absolutely preposterous that this took place. And again, I just think, we should have a fair playing field for everybody. We shouldn't pick winners. And like this week, I don't know if you saw, but now Trump's team's out there touting, we're going to get 10% of Intel. They want Intel to give them 10% of their stock to benefit from a CHIPS Act. No, here we go. I didn't like it when Obama did it. I certainly am not going to like it when Trump does it. We should not be trying to pick winners and losers. It's nonsense. Stay out of the way. We need smaller government.
Well, and I just want people to know we practice what we preach here, David. Now, you like to say, look, folks, I vote generally with my right hand, and Jesus Christ is my Lord and Savior. I just like to put that out there. I'll work with anybody. I'll help it. We have same-sex couples who are clients
tons
of
of
Retire
them, yeah.
Smart. And so and that's the way America should work. We're glad to work with you on retirement planning. We don't care about your politics and other things.
Well,
that's been the beauty. That's been the secret sauce of America over the decades
you and I, we talk politics on the show a lot because it matters, right? The way people vote will affect our constituents, our clients.
It has economic and financial implications, of course.
So as I say all the time, I don't really care about the person, or excuse me, I don't care about the party or the person. I care about the policy. What policies will they enact, vote for, or bring to the table to enact that will benefit my clients and our listening audience? So, I mean, it's pretty simple, but again, simple and logic, they don't really work.
David, you sent the team some info here on sales growth, or lack thereof, for restaurants and bars over the last 3 months. I thought summertime was like peak activity for restaurants and bars, but according to this chart, that ain't the case.
Yeah, so we're seeing people are pulling back mightily. Now, here's the funny thing is fast food's really taking it on the chin. So you would think that fast food would pick up when people tighten the wallet, but fast casual dining, kind of like where you would go to a TGI Fridays or an Applebee's style, is doing much better relative to the fast food chains, McDonald's and Arby's, et cetera. And you would think it would be the opposite. However, they are, even the fast casual is what I'm showing you, the bars and restaurants, a massive drop the last two quarters. And so this is telling you America is getting tapped out. We've been talking about this. The stimulus money has run out finally, and folks are having to tighten the belt, and that's going to lead to an economic slowdown. And unfortunately, I think you're going to see worse job numbers as the year goes on. As much as I want to tout, hey, do we still have a thriving economy? I'm a little nervous right now on where we sit.
So this is that dichotomy we've seen for a while now. The market's roaring and so forth, but the underlying economic fundamentals maybe not as solid.
Yeah, and we talked about that last week, the valuations being rich. Well, the market has started a decent little pullback here. We'll see if it actually turns into what we call a correction or so, or just a little dip. But, again, the point for the listening audience is just make sure you understand the amount of risk you're currently taking.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.